Happy Tuesday, everybody, or not so happy for the markets, but we're off of the lows. I'll put this very simply for everybody. The concern now is about third quarter revenues. Remember, we are not at peak earnings. Third quarter numbers and second quarter and fourth quarter have been going up. And in fact, they went up last week. So here's what we're seeing for the third quarter. These numbers are now questionable. Energy, a big mover, of course, but materials, industrials, technology stocks, all are going to have big gains in the third quarter. We're expecting overall gains of close to 20%, but tech is the big one there with nearly 16% gains. The problem is these may be questionable now because the analysts are starting to look at this and say, well, we don't have numbers yet, but the market is obviously betting that we're going to be bringing our numbers down in the third quarter if we really get into this trade war. Sector exposure, well, it's no surprise tech's down the most right now because they have the biggest exposure to China, 14% revenue exposure. This is the MSCI, which is the big cap and mid cap ones. Materials, industrials, consumer staples, and energy. So it's no surprise if you take a look right now at the sectors that are under pressure today. Technology is the #1 sector that's down. Energy is down. Financials are down because the rate outlook is rather poor. That's a separate story here. Industrials also on the weak side. The big tech names, significant exposure overseas. So you've got Qualcomm, Apple, even though Apple was supposedly exempt from the current round of the iPhone was exempt from the current round. Seagate also to the downside. Remember, you've got a secondary problem here. The dollar index is at a new high for the year, and that is putting a lot of pressure on commodities and commodity stocks of any kind. So if you look at any of the oil names, you look at Marathon or EOG, it doesn't matter what you look at. You look at the steel names like ArcelorMittal, metal names like Freeport-McMoRan. They're been coming under pressure already as the dollar strength has intensified. Elsewhere, in terms of revenue exposure, people have asked me, well, how big is it really? It's not as big as you might think. U.S. revenues from China, and this is mid and large cap stocks, about 5%. These are MSCI numbers that they gave to me. The China revenues from the U.S., almost a half of that, only 2.8% of the companies in China get their revenues directly from the United States. But it's a matter of the supply chain, because once you start getting other companies that are affected here, it becomes much, much broader. It's not just a revenue question. These companies, the supply chains are interconnected all over the world. So it's actually a much bigger problem than those numbers would indicate. Meantime, China's got problems of its own. Did you see what happened here? Shenzhen. That's a 3-year low in the Shenzhen. This did not happen overnight. China's been having individual problems with small caps and mid cap companies. Remember, Shenzhen is like the NASDAQ. So 3-year lows, 2-year lows in the Shanghai over there, which is sort of more established companies. Hang Seng has been down for a while now. So the bottom line here is we are trying to figure out all the supply chain issues. The analysts can't really change the numbers until they get clear indications of what kind of tariffs are coming in, and we don't know that. The market is now speculating, though, that third quarter earnings and fourth quarter earnings are going to come under pressure, and that's why you're seeing the decline. 313 points now in the Dow. Carl, back to you.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.